Okay, so let's start with China's data down. We heard from Mark earlier that, you know what, China's growth, in fact, is not too bad, but there is some disappointment. I mean, retail sales, investments falling short of expectations.
Haslinda, slowdown in fourth quarter, that writing has been on the wall for a while. If you look at leading indicators like Baltic dry freight, after looking very strong in the second and third quarter of this year, it has been weakening the last couple of months. Again, I think on the back of China's slowdown, because it's definitely not weakening on the back of U.S. demand, which is very strong. If you also see what is happening with respect to China's event line, if you will, the Winter Olympics are coming, emission-related controls are in place. I really didn't think that output had anywhere to go other than flat or slow down a bit, and that's exactly what's happening. Our nowcasting model says about 4% growth for this quarter. I think today's data is consistent.
But this is an economy that's facing constraints when it comes to its recovery. And add to that the pressure from the likes of the U.S. Today, we heard how Joe Biden's administration is trying to impose new restrictions on the chip-making industry.
The cyclical slowdown in the case of China is largely self-inflicted. They wanted lending to be scaled back. They wanted to rein in on the excess in the property market. They certainly felt comfortable doing all these things in a year when, at least initially, growth was very, very strong. They came out of the pandemic hole with a great deal of strength. The medium-term headwinds they're facing, whether it is domestic from demographics or the climate transition, or external from the U.S. in particular, I think those are separate challenges, if you will. I would not conflate those issues with the ongoing slowdown in the economy. That's more of a domestic-driven development, in my view. But to your point about the various legislative developments that are happening in the U.S., that's a very big headache for China. There is no way to sugarcoat that.
We look at property. We keep on looking at property. It's the big story of 2021, Taimur. And, you can't help but avoid the pressures on credit and stress really at the moment being elevated. That's got to hurt, and that can, of course, have a global impact.
That's got to hurt. Rishaad, let's take the domestic part first. The pain is substantial domestically, even before we start thinking about the spillover for the rest of the world, which is also considerable. But at the domestic level, I think the pain is reaching the point of becoming unsustainable, and which is why we are talking about triple R cuts, not just the one that just happened, but one more in the offing in the first quarter, and various other easing measures. So on one hand, you want to address moral hazard. You don't want poor lending to be rewarded by evergreening. On the other hand, you don't want the entire system to collapse, because China still sits on substantial amount of growth dynamic coming from the property markets. So yes, we are seeing distress in certain parts. Yes, there are credit events that are percolating and taking place almost on a daily basis. But at the same time, we might be at the peak of the storm. For its own domestic imperative, China needs to slow things down and ease matters substantially. As far as the rest of the world is concerned, the first thing that we are going to look at is the dollar credit space for the first quarter of 2022. China's borrowers have been a big player in that market. Will they get shut out because of the credit stress, or will they get significant amount of continued access because things are turning easy on China? And as I said earlier, that the peak in the stress has already been left behind. I think that's the big thing to see in the first quarter of next year.
Taimur, this brings us nicely on to what happens next with China, because is the central bank there, the PBOC, behind the curve? We had no change in the MLF, the medium-term loan facility, and people are saying that perhaps that means that next week we won't see the loan prime rate change either. If those two don't happen, or one has already not happened, does it indicate perhaps that they are being a little bit too reticent?
Isn't it extraordinary? In the case of the U.S., we talk about behind the curve in terms of not tightening soon enough. In the case of China, we're talking about exactly the opposite, that are they being too late in easing policy? I think that they find the external part of the economy fairly strong, notwithstanding the supply side constraints, and therefore there is some degree of balance in the economy that they can orchestrate some slowdown, some course correction of the domestic part of the economy while relying on the external engine to fire, and hence not head toward, say, sub 4% growth in the fourth quarter and go back into the trajectory about 5-ish growth in 2022. So from that perspective, where China wants growth to be, where they think investment and lending ought to be, I wouldn't say they're behind the curve, but the clock is ticking. They need to move pretty fast.
Transitory inflation was the worst call ever for the Fed, but he says that the Fed and Jerome Powell can make it up by perhaps just stepping on the accelerator, speeding up rate rises and tapering.
Haslinda, for all the talk of the Fed sort of being behind the curve, when you look at market-based indicators, there is no sign whatsoever that their credibility is at stake. When we look at 5x5 inflation expectations, they're well behaved. When we look at bond yields, they don't seem to suggest that the Fed is about to, slip up so badly that we're going to have years of high inflation. All that the bond market is telling us right now is that, yes, in the near term, the Fed will hike, and the Fed is giving out that signal, and tonight that signal will get stronger, and that's fine. But when you look at, for example, say core PCE inflation, and let's say set it to 2015 as 100, because let's say from 15 onward, they're thinking about 2% core PCE inflation. Even at the end of 2022, with all these higher inflation, actual and forecasted, the Fed will barely be meeting its medium-term target. So temporary overshoot should be seen in the context of the fact there were years and years of chronic undershoot. Of course, we don't want the credibility to be challenged, and we want the Fed to stay on top of the curve, if you will, by tapering, by removing excess accommodation from the market, because we don't want negative real rates to persist for too long, because that creates other complications, not just inflation, but asset misallocation, asset market bubbles.
In the end, it is about real rates. What assumptions are you making about real rates? And when you take a look at how low it is, there's no alternative to equities.
Right. I think that the fact that we still have long-term interest rates so low and the equity market yield is still substantially higher than that yield gap, if you will, still favors equity investments without any question. With one caveat, Haslinda, which is the rate of return from the equity market should also be seen in context. It cannot be the extremely strong rate of return that we got in the past decade. So from an earnings perspective, from a valuation perspective, the risk reward is going to be much more modest, if you will, from equity for the next decade. But that's a given there's only so long that you can grow so fast.
Taimur, just looking at, you mentioned that the short end is really looking very closely at where interest rates are likely to be and betting on hikes. So what is the long end betting on? Is that betting, given where we are with it, on perhaps a deep economic slowdown, possibly?
The long end keeps betting on secular stagnation. It's basically saying if you hike rates too much, you're going to create a recession, and all this talk of inflation and overheated economy will be out of the door. So the long end of the market is not convinced that we have years of high inflation ahead of us. The long end of the market is also saying there's a massive demand for long duration safe assets in the world, and the US government is basically the only source of very large amount of liquid safe asset that provides positive yield. And therefore, it is hard to see the curve steepening at any time soon. The act of forwarding or bringing forward the rate hikes, the policy tightening, would only create more and more flattening dynamic in the market, if you will, and that is going to be one of our favorite trades. It has been our favorite trade this year. It'll remain our favorite trade going into 2022.
And Taimur, again, that PPI number yesterday is only going to feed into the hawks, inflationary hawks out there, isn't it? I mean, nearly 10% up. I think we've seen these sort of levels for at least a decade.
Rishaad, let's also take that into context. Yes, we have high energy prices feeding through to PPI, but when you look at a broader range of prices, food prices, particularly food grain, when you look at fertilizer prices, when you look at cost of shipping those products, production of chips, all of those things, in my view, the worst is behind us. We have seen a lot of supply side related disruption beginning last year, persisting through this year, combining with very strong demand. I think going into 2022, we'll see a peak of demand. I really don't see any further catalyst for demand to get any stronger. Rates are going up, fiscal stimulus is being withdrawn, and China is slowing. But at the same time, I see many drivers of supply side crunch getting eased. When you look at chip production going up substantially, when you look at oil, OPEC +3 committing to a higher production quota, when you think about what's happening with shipping rates coming down on the back of China's slowdown. So a lot of the factors that have pushed up prices are coming down. So PPI number, worrisome, pass through, definitely something to track, but at the same time, maybe a backward-looking indicator as opposed to a leading indicator of what's to come.
And add to that, policy could still be broadly accommodative despite normalization.
By all means, we're only talking about withdrawing asset purchases, which surely does not make sense when the real estate market is doing so well. And when we talk about rate increases, Nobody's talking about more than 2 or 3 rate hikes next year. So even at the end of 22, Haslinda, we're talking about sub 1% or just about 1% Fed funds rate. Exceptionally low numbers, very accommodating.